Hey everyone, it's time for another episode of Mayhem in the Markets, brought to you by TraderAid.com. We're a financial media publisher focused on helping individual investors and traders understand more about macro, fundamental, and technical analysis so they can take the reins of their financial future. The first chart we have here is one talking about how much you need to recover from losses, and you can see why it's so important to cut your losses early. After we get beyond a 10% loss, it starts to become much more difficult to recover your funds. So remember, maximize your gains by riding winners, cut your losses quickly, get rid of those losers. There's no reason when you're a trader or an investor to take enormous losses. In fact, it can be really important to consider cutting those. Now, obviously, this isn't trading or investing advice, but if you look at the chart, it speaks for itself. The next chart I have here is one talking about central bank binge on gold. The shiny stuff is getting well bid in this year of rising inflation. While it hasn't acted very well as its role being a hedge, there could be reasons for that, particularly strength in the dollar and rising rates. But if you look at gold priced in other currencies, it's actually done reasonably well. The big takeaway here, however, is the change in character, the surge in demand, the highest levels we've seen in over a decade. And I think this shows that central banks are really trying to diversify their reserves away from the dollar, the euro, the yen, and other currencies, and get into gold because it does ostensibly store its value over time. And central banks need that sort of capability. They can't just rely on fiat currency. We're going to take a little bit of time to talk about the housing market here. It's one of the biggest parts of the economy, accounting for 15 to 18% of GDP. And we're seeing prices slide the most that they have since really 2011, 2012. And this is important because this is a meaningful slide. We get much further, we're going to go back to levels we haven't seen of decline since the great financial crisis. And this is just on a month-over-month basis. The last month-over-month decline over 1%. Why does it matter? Because the housing market has been particularly strong out of basically sympathy for the amount of liquidity that's been injected into the financial system, artificially low rates on top of that, and then a surge of buying in a market that was undersupplied. When the pandemic hit, a lot of people wanted to move. They wanted to leave crowded urban areas and move into suburban and rural areas. And as they did, home stocks dwindled, prices rose significantly, and it was sort of a new paradigm, at least for about 2 years. And now we're starting to see the hangover. And it's a pretty profound one. When we look at some of these regions that are shaded purple, particularly darker purple, you're seeing that in some places around the country, particularly coastal areas, there are homes that are selling at prices of close to 20 times median household income. Those same regions are likely to be more vulnerable to significant price declines. Those 20, 30+% declines that some have predicted, I would say are more likely in these regions. Because quite frankly, when push comes to shove, a lot of the housing stock is completely unaffordable to the majority of the population. And we have a problem with supply. It is growing. We've got 4.1 months of supply available on the market. That's the highest level we've seen since the first half of 2020. So we've gone from a situation where we had too little supply and too much demand to the opposite. Too much supply and too little demand. And that's likely to further add downside pressure to real estate pricing. There's also a lot more supply that could be released from how many folks bought second, third, or fourth homes for vacation, Airbnb, rental. Similarly, investors binged on buying homes, and we're seeing some signs of stress. BlackRock's private REIT, they've shut down or at least limited redemptions. They may eventually shut them down, but here's the big takeaway. The real estate market is a much slower market. You can't transact in seconds or minutes like you can in more liquid markets. In real estate, it takes weeks or months. So price declines sometimes take a longer period of time to be realized, and this is going to be no exception. We see buyers stepping away. Costs are too high for a mortgage. Home prices haven't fallen quite enough, and their costs have risen across the board elsewhere, whether you're talking about food or energy, the cost of capital. Everything's gone up, which means home buyers have less money money to put into a mortgage, and mortgage rates have surged, rising from about 2.5% to up to 7% this year. We've seen a little reprieve, a sigh of relief, but not nearly enough to let houses be affordable at those somewhat lower rates. So what does that mean? It likely means we've got more downside pressure to come across the entire housing market, particularly in those regions that seem more overpriced. This has been one of the worst years for stocks and bonds together. We could say 1931 for stocks was quite a bit worse, but there's been no other year like 2022 for bonds. In fact, for the 10-year note, before we had some gains recently, it was the worst year since, get this, 1788. I don't even know how they go quite back that far to look at bond prices. I guess they have maybe some parchment with some, ink scrolled on it. But, nevertheless, bond prices have had a complete collapse this year. It is the worst year that we've seen for this return complex between stocks versus bonds. And quite frankly, for the 60-40 funds, it's been one of the worst years in about 100 years. So what does that mean for us? It means there could be some interesting opportunities in the bond market, particularly in investment grade and U.S. sovereign debt. I like shorter duration. So I'm looking at the 1s, 2s, and 5 years of U.S. sovereign because, hey, if I can get about 4% or more on a 2-year, that looks pretty decent to me. And that's looked pretty decent to me for a couple of months. I don't mind lending the government that amount of money for that short period of time because I don't feel there's a particularly high risk of default. And quite frankly, equities are probably going to produce substandard returns over the same period of time. So that's how I'm looking at this. It doesn't mean I'm correct, but that's the point of view I have looking at this chart, looking at where bonds have gone, looking at the yields as they are now, and then also taking into consideration that bond yields on the 2-year probably won't go terribly further unless the Fed gets much more aggressive with their hiking. The next chart we have here showing appetite for longer duration U.S. debt is the biggest inflow in TLT ever happened recently. Why does that matter? Because it may tell us that there's some appetite for U.S. sovereign debt, particularly this longer duration debt in the here and now. Why would people want to buy a 20 or 30 year at a lower yield than a 2 or 5? I don't know, but the demand is there and it's meaningful enough to take a close look at. And underneath the surface, we see households, hedge funds, and institutional managers as the largest buyers of bonds as the Fed, China, and Japan, who were the largest buyers, have stepped back. We also see a alarmingly high level of short interest in the 10-year note futures that suggests that there are some forced buyers here potentially should prices continue to rise. And for the Fed, financial conditions are far too easy. This means they've got a lot more work to do. The idea that the Fed is going to stop with their hiking or quantitative tightening anytime too soon is likely a bit of a fable. We looked at house prices being too high for most people in these coastal regions where they're up to nearly 20 times median household income. This is just another sign of just how high those prices are and how much more room they have to come down, in the sense that financial conditions are too loose, and as they tighten, mortgage rates will go up further. People will also experience a higher cost of capital, and their savings will shrink as the price of the bonds and stocks they hold is likely to go further down. That, in turn, is likely to reduce the price of homes further because it's going to give people less ability to borrow. And on top of all that, we're seeing banks shut down mortgage departments and tightening lending standards, making it harder to even get your foot in the door as a buyer if you want to buy at these prices. Equity funds, they're still seeing too much interest. On a rolling 24-month basis, we haven't seen anything resembling de-risking, raising of cash, and this tells me we're nowhere near a bottom. In fact, if anything, this tells me we could have quite a bit more pain to come in this bear market. We really want to see this roll off meaningfully. We don't necessarily need to see a deep decline, but we do need to see a cessation of this very strong demand. Looking at Bitcoin versus central bank balance sheets, it becomes clear that over time, more and more, it is strongly correlated with the growth of central bank balance sheets. Now, there is a little bit of chart crime going on here with ratios, but let's just take a backseat to that. Looking more at the relationship here, we can see that if cryptocurrency really is a speculative relief valve for excess liquidity, then indeed we've got more room to the downside as quantitative tightening continues to shrink central bank balance sheets. In fact, the Fed is going to achieve a run rate of close to $1.1 trillion a year. And that tells us that there's plenty more room for liquidity to come out of the financial system. And as a result, lower prices for crypto, stocks, bonds it's quite a likely outcome. Final chart here we're going to talk about is that CEOs make 399 times as much as typical workers. This is the CEO to worker compensation chart from 1965 to 2021. And we can see that it's just absolutely absurd, especially when we look at the disparity between worker productivity and their compensation, which hasn't risen commensurate with their productivity since the 70s, or about 50 years of undercompensated workers, which makes the whole idea that wages are rising too fast and too high a bit comical when you look at this chart and say, okay, but what about CEOs? So this has been an episode of Mayhem in the Markets. I'm Mayhem from TraderAid.com. I really appreciate you tuning in. If you want to check out more of this type of content, check us out on TraderAid.com. Get 20% off any plan by using Mayhem20. That's coupon code Mayhem20 at checkout, and you can get 20% off your first month or year of TraderAid or TraderAid Plus. Hope to see you there, and wishing you a great week ahead.